Liquidity sweeps are the most powerful way to trade the market, and yet 99% of traders who try fail. The reason is because there are hundreds of different liquidity sweeps that happen every day, but most of them don't work. It's only when you truly understand which one does that they become unstoppable. It took me years to figure out which ones work and why, and today I'm going to share that exact blueprint with you. For you to truly master this idea, I'm going to break this video down into 3 parts. In part 1, I'll be explaining exactly what liquidity is and how it really works. In part 2, I'll explain to you what is a liquidity sweep versus a liquidity run and what the difference is. And in part 3, I'll walk you through a step-by-step trade example taken today using both liquidity sweeps and liquidity runs. So this is the trade taken from today. Now in part 3, this is the trade that we're going to be looking at breaking down step by step. But before I break this down, I need you to understand the philosophy of why I took this trade. That is why I broke this down into 3 parts. So part 1, I want to share with you a true understanding of what is liquidity and how it actually works. Now, you hear people talk about liquidity and they make it out to be such a complicated process, when in actuality, it is super simple. Liquidity simply refers to money. When you're looking for liquidity, what you're looking for is money. And here's the truth. Liquidity is absolutely everywhere in the market. The thing is, it's just in some areas more than others. So when we're looking at liquidity, we want to be looking at areas of large liquidity. Now, how does liquidity enter the market? Liquidity enters the market in one of 3 ways. The first way that liquidity enters the market is opening a position. So anytime that you have a buy order open or a sell order open, whether it's a market execute, a buy stop or sell stop, or a buy limit or sell limit, when that gets triggered into the market like this, at that moment in time, that is your injection of liquidity into the market. And so let's say you're buying, for example, or you're buying into the market, which means you're putting your liquidity into the market. There is a counterparty on the other side of the market who's telling the opposite side of the trade. So if you're buying, 10 lots on euro dollar, there has to be someone on the other side of the market selling you those 10 lots. That is usually a market maker. That is their job. A market maker is there to provide liquidity to whoever needs it, to make sure the order book is stacked so that anybody can get access to the market and they make their money off the difference between the bid and ask. That is a market maker. So when you enter into a buy position, that is you entering buy side liquidity into the market. The second area of liquidity that comes into the market is when you hit, let's say, a take profit. So when you hit a take profit, which is the area that you have agreed upon to close out your trade in a profit, when you hit that take profit, that acts as sell liquidity. So you're buying your 10 lots worth of euro dollar at this price, and you're selling back those same 10 lots to the market at a new price. And so at this point in time, 10 lots of sell side liquidity come into the market. The third area that liquidity enters the market is when price hits your stop loss. So let's say you get triggered into a buy position, and for many of you, you may be experiencing more stop losses than not. Every time that you hit a stop loss like this, when price tags you out of that position, you are indeed selling your 10 lots back to the market at a loss. So you bought 10 lots here and you're selling the 10 lots back to someone else in the market at this price, and you net the negative difference. The same is true for a take profit. When you hit it, you're selling those same 10 lots at this area for a net positive dollar return. So that is the 3 different ways that liquidity enters the market. So that's liquidity. Liquidity is money, and that money comes in either through entries, stop losses, or take profits. Now you have to ask yourself, where is the most available liquidity? That is when you have to try to understand the other market participants, because liquidity, as we've said, is orders, and orders are placed by someone. And there are commonalities in market participants' behavior. And so here are the most common areas of liquidity. So the most common is highs and lows. At any time you see an area of price like this, where price is moving in this direction. Let's say price has a little bit of a pullback like this. The most common areas of liquidity at this moment in time are below this low and above this high. That is where the most liquidity is resting in the market. The reason behind that is because most market participants like to put their stop losses or their orders at highs and lows, just the psychological element of safety. So buyers that are stepping into the market and expecting price to go higher, when they enter the market, the likelihood is they ask themselves, where should I place my stop loss? And they are going to be looking to place their stop loss in a logical place, which is usually below a low. Now, sellers who are entering the market in here and they're entering sell positions in here, they have the same question. Where should I be putting my stop loss? And then for most of them, they're going to answer the same thing, in the most logical and safe position, which is usually above the high that they're selling from. Then you also have, when these buyers are entering the market, they're putting their stop losses down here. Now they have to set a take profit level. And that take profit level, again, usually comes at a high. So they're saying, I'm buying here. If it hits this point, I'll exit the trade. So there is, again, more liquidity at that high. So now you have take profit levels and stop loss levels. And then the same for this low. You're having stop losses, and anyone who's selling from this region, right? A lot of people are placing take profit levels in this area. So that is more liquidity. So you have stop losses and take profits at the low, stop losses and take profits at the high. Then there's another form of liquidity that comes in at highs, and those are your breakout traders. So breakout traders are typically people who look at getting into the market based off of a break of a high or a break of a low. So let's say, for example, price move like this and price enters into this high, there will become breakout traders. So at this level, you will see people who put buy stops in place that says, if price trades past this level, I will get entered into my buy position because they're expecting that if price breaks this high, the trend is likely to continue. And so now you have the take profits of the buyers who brought in here, you have the stop losses of the sellers who sold in here, and you have the entries of the potential buyers that are going to buy on the breakout. And so you can see how all of this liquidity starts piling above this high. The same is true on the opposite side of the market. If price enters down into this area in here, there are going to be sellers waiting for this price point to break so that they can get involved in sells and try to trade with the trend. When we trade through this area, their sell positions will be entered into the market at this level. So now all of a sudden, at this low and at this high, you have down here, you have stop losses, you have take profit levels, and you have entry levels. So you can see how there is a lot of liquidity that rests just on the dependence of this low. The same is true for this high. Stop losses, take profits, and entry points. So there is a considerable amount of liquidity resting at highs and resting at lows, as opposed to less liquidity that may just sit inside of the price range. Inside of the price leg, usually most of the liquidity is going to be in the form of entries. So people who are entering inside of the price leg, as opposed to people who are looking to break out and place their stop losses or their take profits. And so that's why the most common form of liquidity is going to be your highs and lows. Another way to look at highs and lows as liquidity is equal highs or equal lows or support and resistance. Pretty much the same thing. When you get price moves like this one in here, and then somewhat of a reaction to the downside. When you get something like this, what happens is another form of market participants join in, and the load gets even larger, because as this high gets respected and starts trading away from it, well, now you have different characters entering the markets. You had the old sellers that had their stop losses. You're going to have the old buyers who place their breakout trades. You're going to have the other buyers who place their take profits. Now you're also going to have new sellers who step into the market because their strategy is equal highs, or their strategy is an area of resistance. An old high that has traded back into and had a reaction induces a lot of market participants to come and trade and participate in the market at that level. And guess what? They too are placing stop losses above these highs. The same again, more breakout traders come, because now this isn't just a single high, it's equal highs. It's an area of resistance. So if we break out this level, more traders will come, because the breakout now isn't just a high, it's an area of resistance that they will hope gets turned into an area of support. Or the equal highs being taken out is a stronger sign of bullish momentum, which induces more buyers. So you have equal highs, and then sometimes you'll have the same for equal lows, like this. You have equal lows down here, and that's going to give you the exact same. So what you want to be looking for are lows, highs, equal lows. Some other forms are, trend lines and some really powerful sessions, right? Because not all highs and lows are the same. Not all highs and lows are equal. There can be prioritized highs and prioritized lows. I'm going to dive deeper into that in phase 3. So what is a liquidity sweep? And more importantly, why do they happen? Let's first start with what actually is a liquidity sweep. Very, very simply put, a liquidity sweep is when price breaches a high, fails to close above that high, wicks above that high, and then closes back inside of the price range. The opposite can also be true in a bearish example. Now, that is what a liquidity sweep looks like. That's the easy part. That's what everybody understands. Everybody understands what a liquidity sweep is, but very few understand why a liquidity sweep happens. To understand this, you need to understand the basics of an auction market theory. Essentially, for every buyer, there must be a seller. Meaning, if you want to buy 100 lots of euro dollar, there must be someone on the other side of the market willing to sell 100 lots of euro dollar. This could be 100 different people all selling one lot. It could be 2 bigger people looking to sell 50 lots. It doesn't matter how many people. All that matters is how many lots are available at any one price point. Now that you understand that every buyer needs a seller and every seller needs a buyer, you need to understand how an institution operates. You see, institutions, when they want to place large orders in the market, they know that they have large volume. That means that if they want to place a position, it's going to be a big position. But for them to do that, they need somebody on the other side of the market to take that position. Well, what do you know? We understand that at highs and at lows, there are these large liquidity pockets. What is in those liquidity pockets is a large amount of orders. And so if an institution wanted to sell 100,000 lots of euro dollar, let's say hypothetically, well, if they just sold at market price, here's what would happen. So this right here is the order flow. This is what's actually going on in the market. This is what the real market looks like. I'll throw a picture up of the real order flow right now. As you can see that this is a simplified version of it because I need to explain something to you. You see, every single candle that you see, every phase of candles, this is independent of time frame. So if you're on a 15-minute time frame, this is a 15-minute candle. And inside of this 15-minute candle, you will see the 15-minute order flow for that candle. Let's say that they were daily candles. So inside of this would be the daily order flow. And inside of the daily order flow, you would see this. Now, inside the market, inside the order flow, you will see the bid and you'll see the ask. The bid is the demand. Those are the people who are willing to buy, right? They are bidding on price. Ask is the sellers. They are the ones who are selling. They are asking for the price. Hey, my asking price is this in order to sell. And then the price is the price. So at any one point in time, price will be sitting at any one point in price. That price is considered fair value by both market participants. And here's how it works. The market is comprised of 2 sides. Active and passive. You have active buyers and passive buyers. An active buyer is someone who will step in at the current market price and execute orders. They don't care about waiting for price to come back down to a certain level. They want to buy right now, and so they are willing to buy at a premium. Same for sellers. Active sellers are willing to sell at this specific price right now. They're not waiting for price to come back. Passive buyers and passive sellers are people who are waiting for price to come into a certain area and then they will buy, or then they will sell. So when you're looking at the order book, you'll see all of these pending orders. What these are potential fills. Meaning at any one point in time, these orders can be removed unless they get triggered. When they get triggered, then they get activated into the market. So here's how it works, and here's how you see a candle actually get formed in real time. This candle, the new day, is opening at 104 like this. What happens is at some point in time, let's say an active buyer steps into the market and they want to buy, let's say 50 lots of euro dollar. And so they want to buy right now 50 lots of euro dollar. Well, there is nobody at 104 willing to sell. So what happens is the price seeks the next block of liquidity like this. And then you see the candle move, and this then becomes a bullish candle. So you see that we come up into here and you see there are 9 lots here. Well, what happens is these 9 lots go to 0, and whoever was selling these 9 lots, they get filled on their sells. But this trader here still has 41 lots that are left unfilled. So then if there's no sellers here, then it's going to go to the next block of liquidity, and then it's going to go to 106. At this point, there are 40 units to sell. And so these 40 get consumed and they go to 0, and all of these sellers get triggered into their trade. But there's still 1 unit left unfilled. And so price has to go to the next available block of liquidity to take that. And one of these 30 units will get triggered as a sell. And then there'll be 29 left at this price. But the reality is there's nobody willing to buy from them at this price point. So they don't get filled. So if sometimes you ever wonder, you take a trade and prices hit your entry, but you still don't get filled into your position, that's because there is no liquidity available for your order specifically to get filled at that price point. Then let's say, for whatever reason, this is our high. So we're going to map out this right here as our highest point of price. And then we're going to do it to the low of price right here. Then let's say an active seller comes into the market. And let's say a seller steps in who's willing to sell at this specific price for 50 lots again. And let's say there are, like 4 lots or something at this price point. Then what happens? Price goes and seeks where the liquidity is. So there's no buyers in this price point. So price skips this level. Inside of here, there are 4 lots. Those 4 lots get consumed by the 50. We're still left with 46. Then you have 7 in here, 9 in here, and 10 in here. Not enough to fill the 50. So price comes into here to collect the 7, the 9, the 10, whatever it is. And then this is where price ends up. Now that once bullish candle then turns into a bearish candle. And that is essentially how the candle gets formed. Now, why this is important is because I need you to understand something. Let's say, for example, a large institution steps into the market and they actually want to buy 1,000 lots worth of euro dollar at this point right here, right? 1.01. That's their target price. When institutions come into the market and they build a position, because institutions don't just place a trade, they build a position. I'll explain why in a moment. So they've got an intention of placing 1,000 units of euro dollar, and they have a target of 1.02 to be their average price. Now, here's what happens. Let's say there's 100 in here, 20 in here, 50 in here. The likelihood is there isn't enough liquidity available on the other side to fill those 1,000 orders. So instead of the institutions coming into the market and placing all their 1,000 at one time, because what happens is if they do that, price would end up going from here and absolutely skyrocketing all the way up here. And then all of a sudden, they might have got filled 20 down here, 30 here, 100 in here, 300 in here. And all of a sudden, their target of getting an average order value of 1.02 completely evaporates. And now they're getting 1.1, right? Completely out of alignment with what they wanted to. So what they do is they slowly build a position. They'll put in 50 now, and then it won't really move price, and then more sellers will step in and they'll put another 50 and another 50 and another 50 and another 50, right? That's kind of how they build out a position. That's why you'll often see that institutions build positions in ranging markets. Now, here's the other thing that they will do. They understand that at these highs and at these lows, there is a lot of liquidity, right? So maybe above this high, there might be 1,000 units to sell at this level. Why? Because you have buyers take profits that act as sell. You have breakout traders that are acting as sell side liquidity as well. So what you'll see is they will sometimes strategically push price into these areas so that all of those units of sells get flooded into the market, and guess who's there ready to buy them up and absorb them? That is going to be these guys. These guys are sitting in here. If this institution wants to, let's say, sell, 1,000 units, for example, at this price point, right, or in and around these areas, let's say they're in here, what they'll do is they'll nudge price up into these liquidity pockets up in here where they know there is a large amount of buyers, right? There are breakout traders in here. There are take profit levels. There are stop loss levels. There's a bunch of liquidity that sits in here. So they know that they can nudge price up a little bit, trigger all this liquidity, and then take the other side of it to get a good fill of their value. And they'll do that. And they'll push price into these levels, making everybody believe that the market is, bullish, having buyers flood to the market so that they can get their sell positions in. Now, you'll know that this is happening when you see that price wicks above the high. Because what happens is, as price approaches a high and trades above that level, this is where the magic happens. All of the buyers that are stepping in here, this institution is absorbing all the sells until eventually, guess what? There's no more buyers left at this price point. And so now all there is the rest of the sellers that were sitting at this price point. And so price then comes back down. It closes below this previous high. And that is your telltale sign. Why? Because what the market is saying is that the market and all its participants do not agree that price should be trading higher than this level. They agree that price should be trading lower than this level. And so now the likelihood is that we get an aggressive sell-off that goes in this direction. That is a liquidity sweep. A liquidity sweep is when price aggressively runs a high, wicks above it, and then closes inside of it. But like I said, the why behind it is what's most important, because that, when we get into the next stage, is going to give you a good understanding of context. So understanding that when we liquidate this level and close back inside of the range, that is a liquidity sweep. But like I said, they happen all the time and not all of them work. It's about identifying which ones work and most importantly, why. And I'm going to get to that in just a moment. So that is a liquidity sweep, and that is ultimately a large part as to why liquidity sweeps occur. Now we need to understand what's a run on liquidity. So a run on liquidity and a sweep of liquidity are two very different things. And the reality is most people get these confused, or they call the same thing, they call different things the same thing, not really understanding what is actually going on and what is the difference. So let me explain it to you. Now, you see how liquidity sweep was when price trades over a high and then closes back inside with a wick on the top like this, indicating lower prices. This indicates a rejection, right? A rejection of the idea that price should trade higher, therefore it's likely to trade lower. It's a resistance to that idea. Well, a liquidity run is quite literally the opposite. A liquidity run is when price aggressively trades above a high and then also continues with that same level of momentum. Now, there's two very different dynamics that occur between a sweep and a run, and I want to explain that to you using kind of this order flow in here. So what is a liquidity run, and why is that a lot different than a liquidity sweep? You see, a liquidity run is used differently because it's used to fuel a move as opposed to something else. Let's say, you can quite clearly see that we have a low, a high, a higher low, meaning that this low is higher than the previous one, indicating signs of bullish order flow. Then you have a higher high, meaning this high here is higher than the previous one, indicating bullish signs of order flow. So the expectational order flow, right, the structure of price is bullish. So you're expecting higher prices. Well, we know that down here we have liquidity, up here we also have liquidity. Now, the market is bullish, but still there are obviously sellers inside of this price level. So when a seller has their position up here, well, their stop losses act as buy-side liquidity. And then you also have breakout traders that act as buy-side liquidity. And so a liquidity run is when that liquidity is used to fuel a move, right? So let's say, for example, large money institutions were building up a position. And let's say as price is kind of ranging around at these levels in here, they're building a position, they may give a little bit of a liquidation of an internal low whilst they're building their position like this, right? Once they've built their position, They've got a nice amount of orders set to go long. Then what they might do is they might initiate a little bit of a bullish move because they understand that by doing so, that is going to induce buyers to step into the market and allow the market to move in the direction they need to go in. Because once they've built their position, they can't build a position and then also move price, because what would be the point of that? It wouldn't really make much sense for them. So what they do is they build the position, they start the run, and then they let the rest of the market, the herd, take their position where they want to go. So they've built their position in here. They'll give price a little bit of a nudge. Bear in mind, we're already in bullish order flow. So the likelihood is we're going to go long anyway. And so what happens when they give that little nudge is that buyers start stepping into the market. And eventually, when we go through this high, which is the logical phase of price, there is number one, everyone who's already buying and everyone who's rushing to buy late. Number two, all of the sellers that start to get in. That's why sometimes you see a rejection of a high as well, because it induces more sellers to create more liquidity. Well, what happens then is when price reaches this level in here and all of these stop losses get filled and all of these breakout traders get into the market, what happens is price runs itself, right? Because the momentum of all the liquidity that gets filled in at this level, plus nobody wants to sell price really after we break out the high. So there's less sellers, right? Which means it's easier for price to increase, and there are more buyers. So you have a lot of buyers, not many sellers, and therefore the price rockets with ease. What that does is that takes this position well into profit, and that is a liquidity run. That is when price aggressively breaks a high, but uses the liquidity that's sitting at that high as momentum to continue. Whereas a liquidity sweep uses that liquidity at a high as a mechanism to get filled on the opposite side of their orders, where you can expect price to go lower. So they're two very different things used for very different reasons. So now I'm going to show you how I was able to use both a liquidity sweep and a liquidity run to take a trade that I took today. So this is the trade that I want to break down, but I want to give the overall context of everything first. So what I'm going to do is I'm going to replay price to before the trade occurs, and I'm going to put everything in place. And also, actually, let me quickly show you a live snippet from the video that I send my Prosperity School members hours before the trade plays out, showcasing that this is exactly what I wanted to see today.
We're probably going to be looking to get this contraction, right? The downward expansion. Price moves from this to expansion to maybe continuation, right? But ultimately, this is the phase that we're currently in. So I'm definitely expecting lower prices for euro today.
Cool. So here we are. It is Friday. We're into the final day of the week. We've had a very aggressively bearish euro dollar on the M15 timeframe. Our structure, all in all, is bearish. Quite clearly, we're bearish externally, bearish internally, right? So currently, internal swing high to internal swing low. So when I'm coming into the day, I'm already bearish. We have swing high up here. We have swing low down here. So I'm already bearish. Now, here's the mistake that most traders make. Most traders make the mistake of seeing that price is bearish, but not understanding that it's not enough to be bearish. You have to have a liquidity run or a liquidity sweep, and then confirmation to get into a position. Many people in London session are trying to short already because they think that everything's bearish. They're going to try to sell the continuation. For me, it's like, no. I understand that we failed to take out this low. The responsibility of this high right here is to break this low. If that high does not break that low, that becomes weak. That's one. It's a weak high, which is liquidity. Because again, like I said, not all liquidity is the same. Not all liquidity sweeps work. Not all liquidity runs work. So now I'm going to show you what you need to stack contextually to make sure that a liquidity sweep will actually work. Number one, directional bias. We're bearish. So I don't want to be trying to buy. I'm not looking for liquidity sweeps on lows. I'm looking for liquidity sweeps buy side to go short. That's the first thing. The second thing is context. This is a weak high. Weak, meaning the high failed to take out the low. So it's weak. This is also Asia session high, which means there are more liquidity at this high. There is also equal highs at this high. You can see price comes in, trades away, comes in, trades away, comes in, trades away. There are equal highs at this low as well, right? Liquidity. So we have a weak high, Asia high, and equal highs all in one area, plus we're bearish. There's context as to why this is such an important high. Now here's the thing. Price could come all the way up here, and I would still look to short if I got my right confirmation because we're bearish. But when I seen how sweet the sweep of liquidity was, it was, like I said, unstoppable. It was undeniable that price was going to reverse and run to this low. Because this is also a liquidity target. Because this low down here is the logical path of progression for price to run structurally. Now the thing is there are a lot of sellers that are using this area as their stop loss. And so when they in this area, they're going to have to get out of their positions. There are going to be sellers that also look at, they're going to be buyers in this price leg trying to hold this position, and their stop losses are going to act as sell side liquidity. There are also going to be breakout traders that if we break this low, they are going to sell the market, and that is going to be sell side liquidity. So if price comes into here, the momentum is going to take it through this level, and that is going to be a liquidity run. A liquidity sweep is an area you're expecting a reversal from. Go, collect the liquidity, and then return to the direction. Here, use the liquidity to fuel the move. Very, very big differences. And so what I'm waiting for is a confirmation of a sweep. So if we play 15-minute time frame, you can see we're in New York session now. If we pull back before we even get this, right? This is what it looks like. You can see that we have obviously run the high, wicked the high, and then closed back inside the price point. This tells me that we've just gone and grabbed all the liquidity above this high, and now we're getting ready to move to the downside. My confirmation for this entry is going to be on the 5-minute time frame, right? And what we see is we see this very, very nice liquidation, which is a liquidity sweep, sweeping high and buy. But now I need to see confirmation that we're actually going to reverse from this level. So what I see straight away is that we don't have any structure, but we do have this fair value gap. So this fair value gap here is essentially what's currently holding price. And then when I see price break this fair value gap, meaning we've now inverted this fair value gap, we've destroyed it, that is my confirmation that it's confirmed. Price is very much likely to go lower. That aggressive momentum through this bullish fair value gap, turning into potentially a bearish fair value gap, is my confirmation. At this point, I have to be aggressive. I can't wait for price to come all the way back up to here and then hope it continues back lower, because no, the liquidity sweep has happened. Now we're going to deliver price to the sell side. So I need to be aggressive on my entry. So I need to make sure the risk to reward makes sense, and I can get myself into this position with an execution once we close below this fair value gap. So once we closed, I can look at exiting straight away. Where can I put my stop loss? I can put my stop loss at the high up in here, but because of the sweep, I'm extremely confident that price is not going to come and return to this level. If price comes and returns to, even this high here, if price comes and returns to this high is definitely getting taken. So then I don't need to put my stop loss here, because I can put my stop loss at this old high here, even Asia high, because I understand that if price comes back up to this high here, I actually put my stops here, but if price comes back up to here, like this, then it's definitely coming up to here. So I can save myself, an extra 10, 15%, and add that 10, 15% on my risk to reward. So that is where I'm able to kind of execute my order. Then I need a target. My target is going to be the swing low, because 1, we are bearish. 2, this is the this is the targeted low. We also have liquidity across here, right? This kind of like trend line liquidity that's built in. We have London session liquidity with the equal lows building down there, and you'll see how more liquidity gets formed in just a moment. Another thing, when you become a bit more of an advanced trader, what you can go and see is you can go and look at other potential draws on liquidity. Because if this low gets broken, then the likelihood is that we also have another very old low down here, right? If you go to a 4-hour time frame, you can see here that this is also a draw on liquidity. This is a very nice old low. We have a fair value gap in here. So this can also be used as a secondary target, which is what was used. Now we can go back into our 5-minute time frame and kind of see how price plays out and kind of comment on it as we go, because it's very, very interesting how price actually played out. So price begins aggressively running to the sell side. And then we get a little bit of a reaction here. Now this reaction does what? This area now is being used as an area of support. So now we've got a lot of liquidity that's forming down here as well, right? Price is reacting to this level. You see how price is respecting this level? What it's doing is it's engineering sell side liquidity. That means that when price goes through here, it's going to have an easier time continuing to go lower. A lot of buyers are trying to protect this price level, but it's not going to work. And so look how easily price is able to run through that, because the moment it breaks the low, the aggression takes itself. Now though, we're also building more liquidity on the sell side. With this little reaction that we have in here, right? When price comes up in here, now we have 1 low, 2 lows, 3 lows stacked on top of each other, which means there's even more liquidity at this low than there was before. And you can see price literally jangles around in this area until eventually it breaks it. And also look at the momentum that follows through, right? That is the difference between a liquidity run. You see how price breaks the low and then still the candle just aggressively continues moving lower, right? If you look at a 1-minute time frame, price breaks through the liquidity and all of the other liquidity enables price to go even further to the sell side. And so that is the difference. That there is a liquidity run and that is a liquidity sweep. And that's how you can use them both. But the most important thing is you need context to be able to use them both. Now, if you want a guide on my trading outline, you can check the link in the description. I'm going to leave a free resource there for you to claim.